Good afternoon, ladies and gentlemen, and welcome to today's panel on diversification in an age of shocks, investing through trade wars, rate volatility, and currency uncertainty. We're delighted to convene this distinguished group of investment leaders whose combined perspective span markets, asset classes, and client needs on a truly global scale. Today's panelists represent some of the most influential organizations in global asset management: BlackRock, Allianz GI, and Fidelity Investments. Together, these firms steward an extraordinary amount of capital on behalf of investors across public and private markets worldwide. HPS Investment Partners, a BlackRock company, HPS Investment Partners is a leading global alternative investment firm specializing in private credit and related strategies across corporate and asset-backed lending. HPS is known for its disciplined approach to capital preservation, flexible financing solutions, and focus on delivering attractive risk-adjusted returns. BlackRock stands today as the largest asset manager on the planet, with approximately 13.5 trillion assets under management. I think I received a notification that you've surpassed 14 trillion right now, reflecting its deep footprint across equities, fixed income, ETFs, and private markets. Fidelity Investment manages roughly 6.5 trillion in assets, supported by a broad lineup of mutual funds, managed accounts, and retirement solutions, and serves millions of individual investors and institutional investors globally. Representing Allianz GI, the panel includes Alti Tiedemann Global, a leading global wealth and asset management platform specializing in alternatives, private markets, and multi-asset solutions for ultra-high net worth families, institutions, and family offices. As part of the broader Allianz global investor ecosystem, which oversees approximately 2 trillion in assets under management, Alti brings deep expertise in bespoke portfolio construction, private capital, and long-term wealth stewardship. Collectively, BlackRock, Fidelity, and Allianz manage nearly 22 trillion in assets, underscoring the significance of the perspective shared on this panel. The scale, breadth, and global reach of these organizations highlight why today's discussion is particularly relevant for institutional allocators, family offices, wealth managers, and individual investors navigating an increasingly complex investment landscape. Welcome, everyone. Welcome, Purnima. I'd like to break up this session into multiple sections that I would love to really cover, but I will start on the macro side. With regards to the macro backdrop and currency volatility, this question goes to you, Salman. Maybe you'd be better in leaning into this. The US dollar has faced increasing pressure amid widening fiscal deficits, trade tensions, and shifting interest rate expectations. What are the primary drivers behind the recent weakness in the US dollar? And do we view this as a cyclical adjustment or a more structural trend that investors need to adapt to long term?
Thank you, Faisal, and thank you very much for the lovely invite to speak at this conference. A core fundamental question right now in the currency space in terms of the outlook for the dollar. I'll start with the long term first because I think long term is important right now. And we think and continue to think, and we have been in this camp for a while now, that US dollar is a multi-year downward trend. It's an expensive currency versus its fair valuations. If you look at real effective exchange rates, base valuations, despite the moves last year, we do think that it has to become much more fair valued. And there are multiple drivers of that. As you, I think, touched upon, the macro picture, structural macro picture in the US is deteriorating on the public sector side. And there is no pathway we see which will bring fiscal deficits down given the populism and given the political environment. We don't see much focus on bringing inflation towards the target. The next Fed chair, we'll see how that pans in. Obviously, markets right now are very much focused on it.
Is it political pressure is what we want to know, or is it something that we've known about, that interest rate direction dictates the direction of currencies? This is what we learned in school, and this is what we apply.
That I think you have to now put it in the garbage bin because it doesn't work like that anymore. when you have politically active governments who want to spend money without any restraint, when you have uncertainty around trade relationships and economic relationships between key economic blocs, especially US and Europe, US and China, then the currencies don't move with interest rate differentials, and we have seen that for some time now. And let's start with the capital side of things. Europe is the biggest provider of capital to the US by far compared to GCC or Asia. And there is a fundamental now issue in the trust between those two blocs. And we are expecting home bias, more diversification, capital to be redeployed. So that means you are going to see reduction in demand for dollar. So interest rate differentials are useful in a cyclical sense, but they are not useful in a world where underlying relationships between the trade and capital blocks are changing. So to your question earlier, I think that this is a multi-year downward trend in the dollar. Yes, you will have technicals moves, overstretch moves in the short term, but interest rate differentials are not the lens or the primary lens anymore at the moment.
I think my follow-up question goes to both you, Purnima, and Thomas. In a world where currency volatility is becoming a more prominent source of portfolio risk, how should investors think about currency diversification? Now, should we look at it as a hedge, or should we look at it as a speculative bet in terms of diversifying one's portfolio? I think we'll start with Thomas for that question.
I think from a portfolio construction perspective, and we have seen this across our entire client base, from institutional to basically the wealth channel, I think clients have been already diversifying since basically the early 2020s when we had COVID and money supply went up dramatically. We basically started seeing investors thinking about, okay, we need to diversify our currency exposure. In general, I think a lot of them did that through kind of precious metals, but also through other currencies, especially Asian currencies. Like we have seen other scenarios like these in the past, being the Bretton Woods, being basically the Plaza Accord, being like after the 9/11, where we saw the dollar depreciating by 20-30%, and basically like precious metals, in this case gold, and other emerging market currencies basically being the asset class leader. So we have seen situations like that. I think what we see as a given, and also to help answer the previous question, is the current administration wants to keep this US boom agenda, right? That is basically peremptory. If we look at the last 5 years, US GDP, we went from $20 trillion to $31 trillion in nominal terms. That is a 55% increase. US national debt within the same period we ended last year at $39 trillion. That is a $15 trillion increase, is 65%. So there is like a very large correlation between the fiscal expansion and the US boom cycle as an economy. And that is important because ultimately it costs money to service that debt and it needs to be paid. So that is important also in the mid-cycle, and basically let's see what happens to the current administration. And if I think the priority for this year in the short term, the current administration is going to do everything in its power to basically maintain both like the House and the Senate ultimately, because that is very, very clear. And that is basically the big topic is affordability, and affordability is the price of capital, price of cash rates, price of energy, and price of goods. So probably no tariffs, a continued aggressive campaign around kind of monetary policy. We all know the numbers that Trump have announced as basically seeing the equilibrium numbers for the base rate, and also energy prices. I think we are all aware of the geopolitical.
But abandoning the main driver question and looking at it from a client or an investor perspective, maybe Purnima, you can chime in on this point. Usually, when I see from my advisory perspective, what I see is US dollar products for US dollar-based investors, euro-denominated products for European investors, again, Swiss franc and whatnot. Are we seeing the other way around? Are we seeing US dollar investors capitalizing on the opportunity for a rising euro for the products that they tend to invest in euro? Because obviously, correct me if I'm wrong, over the last year, we've seen a 12% appreciation versus the dollar by the euro, and that represents a very nice speculative bet if you got right.
I think on our side, large
But-
multi-asset allocators.
I just want to get from Pranima's
course.
perspective.
Thank you so much. I think from our lens, there's a couple things to consider. The first is that FX has been able to hedge risk where credit has not been able to hedge risk. So that's for sure in terms of inflation surprises and things like that. One thing to consider, certainly in the example between the US and Europe, is that the European market is much smaller. And so being able to invest in the same types of businesses at the same size and scale on a consistent basis is much more limited from the lens of what we do in terms of credit investing. So I'd say that's kind of point one. I think point two is that when you mentioned the word speculative, that's not our business. I mean, our business is to try to generate returns within a band.
I mean, when I see all my returns wiped out versus the euro, simply because we were in the wrong currency, I think we really have to pay close attention to that.
Yeah. I mean, look, we try to hedge the currency. We try to dilute the risk of currency risk when we're taking our credit bets at HPS.
Okay. Maybe we can switch topics at this point. And this is quite important, but rarely discussed. And I'd like to highlight diversification in highly concentrated portfolios. Many investor portfolios today remain heavily concentrated in US assets, given the dominance of US markets over the last decade in a low interest rate environment. At what point does US concentration becomes a risk rather than a strength? And how should investors address this without sacrificing returns? Again, we see the same concentration in sectors that are tech and tech related with the growth of AI and whatnot over the last 5-6 years. We felt susceptible to that as we benefited from the gains in these sectors and the gains in the US market, albeit concentrated within the same theme. How do we avoid that? And I leave this question to the panel, whoever would like to take it, Pranima, Thomas, or Salman.
So maybe I can start from a strategic asset allocation perspective. Obviously, it's premised on building that kind of diversification you mentioned, Faisal. So the environment and then the historical context is that we have gone into a very concentrated risk-taking because that's where the US has been growing the fastest. That's where the earnings have been, and of course the AI team has also played a big role in concentrating risk and capital to where the potential earnings were coming through, for example, in equity markets. So that's not true in equity, it's also true in fixed income markets as well. This is the biggest risk in sitting in balanced portfolios, if you will. And the diversification needed is across regions, across sectors, and using FX, as we were talking earlier, as a core risk lever in this environment. So, for example, this year, you have to think about mid-caps in the US because fiscal stimulus can potentially come in because it's election year.
On the public market side.
Sorry?
On the public market side.
On the public market side. And then you have basically the very important role of bonds is being questioned. So bonds have been excellent as portfolio risk stabilizers for many, many years now. And that role in a higher inflation, higher politically engineered inflation environment is going to come under stress.
But I think we're living through a period of positive correlation between bonds and stocks. And I think that's an uncomfortable position to be in right now, where we're used to diversify portfolios on a balanced format, being the 60-40 type of a formula. But I think we were abandoning that right now. And it brings me to my question, since we have a strong representation with regards to players in the private markets, is diversification today less about owning more assets and more about owning truly differentiated sources of return, combining public markets and private markets? We'll get to the discussion about private credit a little bit later on, but if you allow me to cover this.
I think that is a great question because, again, we also cover basically the wealth management segment of the market. We have almost $100 billion of wealth management money as well. And we have seen that change very much starting very aggressively in 2022 when basically, again, S&P 500 was down 15%, Barclays Global Ag was down 15%. Investors were coming to us from the wealth channel and saying, I need different risk premiums within my portfolio.
Yep.
in order to basically create more benefits from cross-asset correlation perspective. And at the same time, the second question was, what about private markets? And because they are aware, clients literally, they know these numbers. They come and say, okay, I'll look at the S&P 500, it's more indexed and correlated every year. 4 companies represented 95% of the profits over the last 5 years. 5 companies, basically 40% of the index. And I look at the private market landscape. If I look at the US as an example, 87% of the companies above $100 million of revenue are private companies, are not public companies. So the view was, in order for me to truly increase cross-asset correlation dynamics across my portfolio, I need to own or have more exposure to private market capital structures. And it's very interesting because in the past, these same wealth clients were used to think, okay, private markets are risky, public markets are safe. And that completely changed. I think clients now see, okay, in public markets, you have safe and risky, and in private markets, you have safe and risky. So the amount of clients, and also with the emergence of all these open-ended evergreen structures, which was a big deregulation campaign by both the SEC, the European Commission, don't forget that this is not just investors. It's also the regulators made the conscious decision that the wealth channel, which is theoretically...
Liquidity in the private markets is providing a great diversifier to the overall portfolio. Is that how you would view it?
So I don't think it's only liquidity. We had very much, okay, these clients are doing it just because now there is liquid structures, but most of the wealth channel, it's not the perception even that are liquid. They recognize that it is effectively a liquid asset class or instruments being packaged in a liquidish structure with fund level gates, et cetera, et cetera. The most important thing, it's very difficult for the traditional wealth management client to think about a J-curve, to think about IRRs versus cash-on-cash returns.
Well, we want to avoid the J-curve,
exactly.
Right? We want full deployment. Purnima, could you lend your opinion on
Yeah,
that? I think that's the greatest prospect.
An interesting question. The first is, you asked about public and private return streams, and I do think there's I think the first answer is yes, diversify your return streams. Why? Because in most of these instances, the truth is credit spreads have tightened up. And so therefore, the cost of I would say therefore your cushion or your ability to take a whole lot of risk has decreased when those spreads have tightened. So yes, you want to be diversified. And then within diversification, I think there's multiple prongs. I think that you can invest in public markets and private markets. I think you can invest across diversified return streams. So that could be across investment grade, high yield, liquid loans, private credit on the sort of, I would say, higher quality size, bigger businesses, because the credit markets are now accessing $200 to $300 million EBITDA businesses in the private markets and in private investment grade. So there's a whole gamut across the credit world in the US and Europe, I would say are better markets for us. We're doing a little bit in Asia. I would say more of that happens to be in Australia. But when we're thinking about our portfolios, importantly, you've got sort of the macro of diversification across liquid markets, private markets. But you hit it where you said these markets are really well correlated now. And in that vein, what can you do? You can diversify underneath the hood. So, maximum position sizes, we're trying to get to sort of 1%. Diversification across industries. Software, not only in the S&P was a third of the index in the Mag 7, but software is a huge proportion of many credit indices, as much as 25 to 35%. So you have real sector concentration. Across geographies is super important. And then within the credit portfolios, you want to make sure that you're protecting your credit risk by diversifying across the sort of sponsor world, the non-sponsor world, size of credits, accessing bigger and bigger credits. And I won't give you private credit statistics right now. You mentioned that we'll get to that later in the portfolio. But the short version is, I think in the world we're living in, because of the correlation in returns, number one, and number two, because credit spreads have tightened a lot, one way to protect and maintain returns is via diversification, both across markets and on the micro within the markets that you're investing in.
And across managers as well. With these evergreen structures that are available right now, you can actually get a diversified talent pool of managers, right? So with these evergreen structures, the secondaries and whatnot, and I'll get to you Thomas, with regards to secondary. So I no longer have to deploy my capital to a single name or a single manager. I am able to deploy across managers in a preferable position, hopefully through secondaries, in an evergreen structure. My clients seek solace in the word liquidity, and we'd like to offer them that. We all know that when Murphy's Law comes into play, everything's not liquid, and we run into the 5-year typical structure and typical term. But having the ability to actually get liquidity, whether it's 1 year, 2 years down the line, seems to be reasonable. Maybe not on the institutional side, the sovereign wealth fund side, where they can manage their liabilities, but on the family offices side, the individual investors, high net worth individuals, it seemed to be a very, very good fit. Purnima?
Yeah, no, I think that's right. But remember, I mean, look, on private credit, there's starting to be some talk around liquidity in some private credit.
Yeah.
I will tell you that we haven't seen it yet. Okay, so let me say that. And I say that in the context of some of the articles we've seen. I believe that will happen. So that's kind of one thing. I think two is in the straight down the fairway private credit vehicles, by and large, the good news on liquidity is that there tends to be reasonably high income distribution, which matters. Now, you can get that in liquid markets as well. And again, I'm being a bit myopic because I'm talking about the world of credit when I make this comment. But I think that when things get really ugly, liquidity tightens up for everything.
And provides opportunity.
Depending on
it provides opportunity. Thomas will be highlighting that for us in a little bit. One quick question, and this is to you, Salman. After a prolonged period of underperformance, fixed income has reemerged as a meaningful contributor to portfolio returns. What role should high-quality sovereign bonds play in today's diversified portfolios, particularly in the context of slowing growth and rising geopolitical risk? Keep in mind, investment-grade debt gave us an annualized return of 3.5% approximately over the last 5 years, which is not really attractive when put against other asset classes such as private credit.
Yes, so in real terms, it's almost negative, given that inflation has been averaging in 3% handle. And that's, I think, goes back to that bond equity correlation we were already talking about. This is the macro imbalances are there, and very easy fiscal, obviously, that's the duration risk side of things. And then credit spreads have become very, very tight. In fact, in our asset allocation frameworks, we prefer equity versus credit because the spreads don't pay you for anything which goes wrong. So there's no bad news priced in. And I can rattle off a risk, from geopolitics to macro, which can damage the current setup. So I think the valuations are problematic here. And then also in periods of equity stress, we are seeing that bonds are not helping as much as they historically were. So you are being hit by valuations which are very tight, correlations which are not very comfortable, and then the duration side, which has been affected by the entire fiscal setup and other things. So we have to raise that question that how do you bring that kind of diversification into the portfolios through other means, but right now it's a questionable both from returns and risk perspective.
Switching over to private credit, Purnima and Thomas, and I think this is the heated topic right now on the agenda. Private credit has grown significantly over the past decade. Is the asset class becoming crowded? And are return expectations still justified, given the amount of capital that has flowed into the space?
There's been so much capital that's flown into the space. I think there's a couple things that are relevant. And it kind of goes back to one of your original questions with regard to diversification, and you mentioned manager diversification. I think there's over 1,000, and I have the exact numbers not on me, but I think there's over 1,000 private credit managers now that have come into the space in the last 5 years, of which, of that 1,000, only 10 of them are sort of 10 billion and above, so able to participate and control larger size credits. I I think that you got to bifurcate these credit markets. So the first is, yes, it's getting more crowded. And I think there's been a lot of tourists in the market. I think people come into the market in smaller size to participate in deals. And that's kind of getting back to your liquidity. That makes me a little bit nervous. I think traditionally, if you look at old private credit and guys that can participate at scale in large businesses and control their underwriting, there's a universe of 10 people that are able to do that. And those people tend to be more global also. I think you've seen a lot of headlines lately.
Yeah.
In particular, there was a few headlines. I'm sure everyone here has seen them. You know, it was First Brands and Tricolor. There was specific nuance to both of those. I don't think that's canary in the coal mine, but I do think when
With
you have
regards
these
to
markets that
BDC
accelerate in
structures,
size,
right?
you're
With
going
a
to
lot
see
of the
more and more
redemptions
defaults.
happening from BDCs, right? Is that what you're referring to?
I'm sorry.
The massive
Say it again.
redemptions from BDCs that's happening in
No,
the
I
US.
wasn't referring to that, actually. I think the massive redemptions from BDCs came from a different place, which is a little bit around sentiment. I was referring, there were two really, really high profile bankruptcies that happened in the credit markets that got a lot of press in the US. Both of those led to a lot of comments around the issue that you're referencing, which is, has private credit grown too fast? Have underwriting terms gotten too loose? And are there too many tourists in the market? That was a isolated issue, both of which happen to be fraud and both of which can happen in any market. I don't think that's related to the rest of the universe of private credit. I think with regard to the redemptions in BDC, there's been several reasons why. I think one of the big one has been around a lot of these BDCs have a massive amount of software exposure. We've seen the numbers. I'm sure you've seen the numbers. They range from kind of 25 to 35% in many instances. And I think some of that's been related to the concern around software businesses and specifically with AI. And what that means for some of these sort of, the legacy software businesses. So that's led to a ton of redemptions coupled with people's concern around floating rate and whether the Fed's going to be successful in getting rates down, and therefore the absolute return and the yield profiles will look totally different. I think that's been sort of what's really driven the BDC land. I think in general, credit spreads are tight. Private credit has maintained its premium. So if you think about it in the context of the relative spread of 150 to 200 basis points in core underwriting, that's consistent. That continues to be the case. I think too is that you've had a little bit of a lift in private credit in terms of the opportunity set, because whenever you see a massive amount of volatility, you still see more and more private credit guys able to show up and offer a solution to companies. I think what's interesting is how big the scale has gotten. And I think that's your friend in terms of protection of capital. We have businesses where the average EBITDA, I think I mentioned, was north of $200 million. So look, I think you got to be careful. In my mind, I think that you mentioned diversity, and I think looking at the size of credit funds, figuring out if it's mostly sponsor related or non-sponsor related. There's a lot of private companies that need credit. Looking at the size, are they sub $50 million businesses? Are they north of $200 million businesses? The default rate in small businesses sub 50 million has been almost triple the rate as that of bigger businesses. Yeah. And EBITDA growth in small businesses has been significantly lower the rate than the EBITDA growth in larger businesses. I think that's super important. And then the last thing I would say is that many of the larger folks, of which there are, as I mentioned, there's 10 of them at least, they have in-house restructuring teams and they have the ability to lend more capital to try to preserve your dollars that are at work if things go bad. Not everybody has that. And I think that's a super important thing if you enter a world where there's more volatility.
Now, you mentioned something very, very important, is that we are going to see liquidity events. And for me, stress in the market presents opportunities. And I think, Thomas, you have a mechanism in order to capitalize on these liquidity events, as you have done in the very near past. Care to comment on that, on how you'd go about doing it, what type of strategy, and moving on? Of course.
I think we are very blessed that our largest shareholder is Allianz, and we have had a great relationship for a long period of time. And of course, Allianz has a very large allocator from the balance sheet into private credit, first lien direct lending, have been done doing this as an allocator for basically decades now. They were able to create an origination machine around secondary. So they ultimately have the ability in periods like this, that the one when there is stress in the market, when there is concerns, and there are LPs that are kind of need to raise liquidity.
2022, for example.
Exactly, as an example. Even last year, even Q4 of last year, we saw a bunch of LPs wanting to reduce their exposure to private credit, first lien direct lending, and selling LP interests with great private credit managers, like with the books where the average loan tape is due to mature in 2.5 years, at as much as 5 to 10% discount versus fair market value. And some of these LPs don't want to run big tender offers, have an advisor, make it very public that they are a forced seller, etc., etc. And we have been able to capitalize in a lot of those opportunities. So ultimately, you add another set of risk premium, which is basically that pull to par of being able to buy like performing loans that are due to mature in kind of 2-3 years at kind of 5 to 10% discount to fair market value. Of course, you need to have a team that can properly underwrite these entire loan tapes to understand if NAV and fair market value it's or not the same thing, but it is a very good source of alpha vis-a-vis kind of the traditional BDC landscape, which I think Plurima mentioned very correctly. It's not only the kind of the excessive software exposure. A lot of these portfolios started with 95% first lien direct lending. Now you see more kind of second lien, some preferred equity. There is a lot of PIK. Some of these portfolios run up to 10% in payment in kind as part of the overall income. And it's not strategic or what we call good PIK, is actually bad PIK, companies that were effectively restructured to some extent and that to move a lot of the coupon payments into basically a PIK toggle. So we are seeing deterioration of some of these portfolios. So the most important thing, I think, back to what Plurima said, is focus on great GPs, understand what they are doing. And again, these portfolios, you are not investing in a blind pool. You know exactly what is there. You can basically go there tomorrow, look at the majority of these loans, where I'm in the capital structure, how much leverage there is in the book. What is the diversification? How much loans? How much idiosyncratic exposure, etc., etc.? How much payment in kind? So you can see all these things and then basically make the decision. But the risk premium is still there. You are still getting paid 200 basis over the broad syndicated loan market, basically the CDX high yield market, etc., for a similar risk, and in a lot of times better security packages that you will have in any of those markets. So from our perspective, it has still a very large role to play in portfolios. If you can get paid, again, 9-10 points to be like senior in the capital structure, it makes sense for us.
So essentially, it's a great mechanism. What we're looking at here, I think this is for the benefit of the audience, tapping into the secondary market means we get a higher yield without any leverage attached to the investment, right? Since you're buying these loans at a discount, you get a higher yield on these loans because of that discount. This presents a great opportunity to increase returns without the risk of adding leverage to the portfolio. Is that a good, fair?
That is a good fit. And then it's about origination. Both secondaries and primary, like in credit, it's all about what is this GP ability and right to play and the track record of being able to originate. And I think that is critical.
And I can see the ticker ticking down real fast, but I think I wanted to leave the audience with a very lighthearted question and a very lighthearted comment. ESG, I think it was the number one topic that was spoken about in every conference over the last 10 years. Where has it gone? Care to comment, especially from European firms. Nobody's talking about ESG, or ESG hasn't taken a broader type of a context. So maybe spend 30 seconds to a minute, each and every one of you. Salman, we can start with you.
Sure. No, I think ESG is there, but it's in a different form. It's energy security guns now, rather than what you used to call. So the defense is part of ESG now. So the definition is evolving, and I think for sure. But I think in some areas it is becoming more serious in the sense, like if you're looking at climate adaptation strategies, climate mitigation strategies, and the interplay with geopolitics is very important. So A big debate in Europe right now is China's lead on EVs and renewables, which obviously had that climate angle, but also has a very powerful geopolitical angle because renewables are very geopolitically secure technologies. As we are finding out that supply chains, especially on fossil fuels, can be very, very dangerous. And you are seeing now push towards security of energy supply chains through the renewables and solar wind angle. So I think it's more it's evolving basically. That's my point.
Thomas, care
Yeah,
to
I would
comment?
agree that it's definitely evolving. I think energy transition and basically energy security are at the forefront of any government today. I think, of course, from an investor landscape perspective, a lot of investors got burned. It was a long duration asset. It was a long duration play. As soon as we had the interest rate reset, you had a lot of multiple contraction in the space, and people got burned. So I think it will take time. We see investors doing it today and participating in it mainly through infrastructure, both equity and debt-related infrastructure, but not yet within the kind of public market space. At least that's what we are seeing from our side.
Purnima?
Same. I think the definition is broadened to sustainability, energy transition, powering the value chain across AI. I don't think it's totally dead, but I think it's shifted and broadened its definition.
Final question for you, Purnima. What time is it where you're at?
It is actually, it's great. It's 5:24 a.m. I'm going to go work out soon.
Thank you.
My panelists, thank you so much for making the time to come and join us. And thank you, everyone.
Thanks, guys. Bye-bye.
Thank you.